Hi there. Welcome to the second session of our virtual learning series. So without further ado, I would like to introduce to you Peter Hapgood, our Director of Education. Take it away, Peter.
Thank you, Kim, and good afternoon. I would like to thank all of our first responders and city employees who have worked tirelessly to provide and secure everyone's safety in their respective communities throughout the state of Florida during this very, very difficult time. It is a pleasure to welcome all of you who are participating in the second session of the FPPTA Virtual Learning Series. Today, we have the benefit of listening to two of our best-known FPPTA associates who are very influential professionals in the public pension industry across the United States. Mike Welker, Managing Partner and CEO of AndCo Consulting, along with Brad Heinrichs, President and CEO of Foster & Foster Actuaries, will share their thoughts and expertise regarding the investment and actuarial realities due to the COVID-19 pandemic. I know you join me in welcoming Mike Welker.
First, I want to thank all the first responders and those on the front line for all you've done since the start of this pandemic. And second, I hope everyone stays safe as we all figure out how to reintegrate back into our daily lives, both personally and professionally. So today, our presentation, What are the investment and actuarial realities due to COVID-19? My goal is to provide trustees with 5 tools to help administer your retirement system based on the investment realities of COVID-19. I know Brad is going to do a great job discussing the actual realities, but my part, I want to talk about the investment realities and 5 tools to help all trustees. Before we get into those 5 tools, I do think it would be good to take a step back and analyze what has happened so far with the equity markets to provide some context. I'll also reference some of the points that I'm going to discuss in these first 2 slides later on in my presentation when we talk about the 5 tools. So if you look at this first slide, what this slide is showing you are the last 3 significant drawdowns in the market going back to 2000. We have the tech wreck around 2000, the technology wreck. We have the great financial crisis, and we have most recently COVID-19. So the COVID-19 experience and the S&P experience is in blue, the great financial crisis is in red, and then kind of in the off green, that's the tech wreck. And what's unique about this is that COVID-19, the S&P 500 fell 34% over the course of 23 trading days. That's from peak to trough. If you compare that to the great financial crisis and the tech wreck, the great financial crisis, the S&P went down 55%, but it took 355 trading days, almost 1.5 years, because again, we're talking trading days, not weekends and holidays. So 1.5 years compared to 23 days, half a month essentially. And then the tech wreck, 529 days, trading days to go down 47.4%. Both the great financial crisis and the tech wreck are cumulative numbers. And the tech wreck, the 529 trading days, 2.1 years. So again, the main difference, the main reality of this most recent drawdown was just the speed and the velocity of how the market went from its peak in late February down to its trough in March. And what led that was the uncertainty and the fear and a tremendous amount of emotion, which again, I'll reference when we talk about the 5 tools that trustees can consider during periods like this. Now, another interesting perspective, if you go to the next slide, what this slide shows you is essentially on the far left-hand part of this page, starting in 2007, the great financial crisis, when you have the market going down over those 355 trading days. And during that market, meltdown, that market sell-off, a lot of investors were rethinking their asset allocation strategies and wanting to get out of equities because this time it was different. But what's interesting about this chart and what I want to remind everybody is the resiliency of the US equity markets. And you can see over time, markets have dramatic drawdowns, but over time you can see they recover their losses, they hit their peaks, and then they march forward. On the next slide, we'll talk about the 5 tools trustees can consider based on the investment realities due to COVID-19. I'm going to briefly talk about each one of these on this slide and then provide specific information regarding 3 of these tools on the remaining slides at the end of the presentation. But there's one thing I want to start with for everybody to remember as we get into these tools. As institutional investors, and most people listening to this presentation are institutional investors, you're associated with a retirement system, a public pension fund. As institutional investors, our general recommendation is to stick with these basic principles or these timeless tools I'm going to talk about, many of which are detailed in your investment policy statement. These timeless tools are effective considerations for not only weathering the current economic storm, but more importantly, helping position the portfolio for future potential success. So let's get into these tools. The first one, reaffirm long-term objectives. During periods of market or economic stress, it's important to reaffirm and understand the ultimate goals and objectives that the portfolio is trying to achieve. It's important to evaluate whether current market conditions have materially altered the portfolio's long-term goals, the time horizon, and overall risk tolerance. Reaffirming long-term objectives allows everyone associated with the retirement system to take a step back from the day-to-day barrage of news and the emotional or short-term mindset that the daily news cycle might create. What you'll probably find as you take that step back is that your long-term objectives remain sound and that the portfolio remains on track under the current objectives. If that is the case after review, it's not typically advisable to make significant change during times of crisis and instead remain strategic or long-term in nature. All right, so that's the first one, reaffirming long-term objectives. Number 2 is reaffirming liquidity needs. Now, under normal market conditions, cash flow requirements are often factored into discussion of goals, objectives, and constraints. However, during periods of market dislocation, liquidity management deserves its own special focus, which is why this is a tool. Whether the portfolio is meeting regular beneficiary obligations or funding investment capital calls, it is not preferable to source cash flows from depressed assets or assets experiencing a liquidity crunch. So it is very prudent for portfolio fiduciaries or trustees to actively involve their investment professionals and utilize their collective insights as part of the liquidity planning process. Number 2. Number 3, conduct rebalancing when necessary. Okay, much like the first 2 that I just discussed, the first 2 tools, a disciplined rebalancing strategy should be part of a well-defined portfolio's investment policy. Now, this is important. We acknowledge that rebalancing is one of the most stressful portfolio decisions to undertake during severe market movements. We get that. This is another scenario where open discussion and scenario analysis can make these difficult rebalancing decisions easier to stomach. In our minds, rebalancing is not a market timing event, nor does it have to be an all or nothing prospect. Each portfolio and rebalancing event is unique, so evaluating a variety of potential approaches to this, such as staging multi-step transaction, can help to lead to better results for each situation. All right, that's the third tool. The fourth tool to consider, analyze the portfolio's investment management structure. All right, during periods of market stress and dislocation, experts tend to come out of the woodwork and talking about ideas that they have. And if they're there to sell something, their guidance could be suspect. Fortunately, in addition to your investment consultant, each portfolio has its own set of experienced market professionals on staff in the form of investment managers that trustees can leverage. Trustees should engage their investment manager and managers to gather insights to better understand how assets are being managed in the current environment and what these professionals are observing day to day in the marketplace. These trusted insights with existing partners will help turn down the general market noise and keep the focus on assessing how the current investment environment is impacting your portfolio and what your existing managers are potentially doing to capitalize on that. And finally, the last tool is assess the viability of new market opportunities. So the four previous tools that I mentioned were more defensive in nature. This tool is more offensive. Every crisis and significant market drawdown inevitably creates investment opportunities that aim to take advantage of the evolving market dislocation. Don't take a fear of getting left out mentality, but instead take a methodical, fact-based approach and determine what investment opportunity may provide the best risk-return profile for your retirement system. As I mentioned earlier, before I went into the 5 tools, my last 3 slides, I want to reference and go back and support the tools that I talked about previously. This slide supports the reaffirming of long-term objectives. If you remember earlier in the presentation, when I showed you the dramatic drawdown that COVID-19 has experienced, what happened with that significant drawdown is that some capital market assumptions came out mid-cycle and basically reassessed what their capital market assumptions were going to be on a go-forward basis. And as an example, many of the risk assets, stocks, specifically US large cap stocks, international stocks, high yield bonds, and real estate, those returns, what you're seeing on this graph, those returns increased almost 2% per asset class on a go-forward basis. So basically what that's saying is if you go back and reaffirm your long-term objectives and you look at your existing asset allocation, there's probably a good chance, based on some adjustments that were made with the capital markets, that your current asset allocation has a good probability of meeting your long-term objectives. And that's what we're talking about, of reaffirming long-term objectives, using data like this to support a strategic plan you have in place. On the next slide, conducting rebalancing when necessary. What this slide shows you is that we go back to September 1929 to June 1932, and then go all the way to November 2007 to November 2009, and again show bear market periods, S&P losses of greater than 20%. The second column shows the drawdown duration, or the number of months that the S&P was at its peak and then went to its trough. The third column shows the total loss, and then the fourth column shows the duration to recover, so to go from trough back to peak in number of months. And as an example, the first line there, September 1929 to June 1932, 83% drawdown. You can see that duration was 151. What this chart is showing is that if you rebalanced and at the bottom, at the trough, you took 50% of your losses and you rebalanced back into the S&P 500, what this showed is the duration to recover your losses went from 151 months to 12 months. And if you look at every bear market period on the far left, that first column, what we're saying is that either the duration to recover was either the same or it was dramatically less if you rebalanced. And so what this chart is showing is really the support for the third tool, which is strategically rebalancing when necessary. And then finally, on the last slide, what this slide is supporting is assessing the viability of new market opportunities. And what we're saying here is we're looking at market opportunities within the high yield fixed income space. And what we're doing is we're saying when high yield interest rates get to be at a 9% spread over treasuries, and how that happens is when investors get scared, like they were in February and March this year, and they sell risk assets like high yield. And when they sell something, the security price goes down, and in fixed income, the interest or the yield goes up. And they have a flight to quality where they go into treasuries or safe investments. And so those bond prices go up and the interest rates go down. So the spreads between high yields and treasuries expand. And in this chart, what we're seeing is if you go back over time and you look, whenever high yield spreads are at 9% over treasuries, what happens over the next 3 and 5 years? And what this shows you is high yield securities, over the next 3 and 5 years after spreads get to 9%, are up almost double digits. And that's a great market opportunity that you could consider if you're in high yield to reinvest back into it, maybe add a little more, or look at this asset class as something to invest in to help your portfolio on a go-forward basis. So what this slide supports is the assessing the viability of new market opportunities based on risk return profile and market data. So in summary, these 5 tools that I just talked about are by no means a complete list of actions trustees can undertake, but they are a good start for any trustee to consider when dealing with the investment realities of COVID-19 or any period of extreme market stress or dislocation. Thank you.
Thank you, Mike. We have already received a couple of questions from our listening audience. Our next speaker, Brad Heinrichs, is no stranger to many of you. Brad has been the president and CEO of Foster & Foster since 2005. Thank you for being with us, Brad. Take it away.
My name is Brad Heinrichs. I'm an actuary with Foster & Foster, and I'm here today to talk about the actuarial realities due to COVID-19. The last time I looked at the stock market, the Dow Jones Industrial Average was down about 9% since 10/1/2019. Most Florida public pension plans are on a 10/1 to 9/30 fiscal year. So I'm assuming that your plans are down probably around 7% or so for the fiscal year to date. This isn't the first time that this kind of thing has happened in that plans have lost money in the market. This time it's a bit different because tax revenues are also falling sharply. Lack of sales tax, which makes up about 50% of a state's revenues, combined with state unemployment claims and healthcare costs rising, can be a recipe for disaster for many cities and states across the country. As you know, when states suffer, it trickles down to the municipalities and they're negatively impacted as well. When we look at public pension plans, the fundamental equation always applies. B plus E equals C plus I, okay? Benefits plus expenses equals contributions plus investment earnings. As I just mentioned, investment earnings being down for the year will certainly have an impact on future funding requirements and contribution increases, okay? The difference here is that contributions, the contribution increases come at a time when the tax revenues for many of the municipalities are lower than anticipated, and that can have a negative impact on budgets. On the next page, you can see we really would prefer to have large investment earnings, which create lower contributions to pay for substantial benefits. That's ideal, but that's not the situation we're in. So are we really in a huge bind here in the state of Florida in our public pension space? That's really the question, because many people are going to be reading, you'll be reading in newspapers about how corporate and public plans across the country are being negatively impacted as a result of this pandemic. The next several slides, I'm here to tell you why I think Florida public plans are going to survive this pandemic better than most. The first reason is because in Florida, we tend to have a timing lag of our contribution requirements. What do I really mean there? Well, the actuarial valuation that will capture the impact of our current year's investment losses will be the 10/1/2020 actuarial valuation. Well, the 10/1/2020 actuarial valuation develops the funding requirements for the fiscal year that starts 10/1/2021 and goes to 9/30/2022. Okay, so the current year's funding requirements for 2020 have already been determined. Next year's funding requirements for fiscal 2021, those contributions have already been established. This pandemic and the downturn in the markets will not impact your plan until fiscal 2022. Most all plans in the state of Florida have a timing lag implemented as a method in their plan and their actuarial valuations. If your plan does not have this timing lag incorporated into it, there's no time like the present to establish this. The next thing I want to talk about that will help Florida public plans survive this pandemic is asset smoothing. Almost all Florida public plans smooth asset gains and losses over a 4 to 5 year period. Some Florida plans even have deferred asset gains built in from prior investment gains that will provide a cushion against this year's losses. So when you lose money in the market in 2020, the first thing we do is smooth those losses over a 4 to 5 year period. Once they've moved through the smoothing process, they're amortized over a 10 to 30 year period. So the next bit of defense that we have in Florida that corporate plans don't necessarily have are our amortization process, or amortization periods on this next slide. Many of our clients have gain-loss amortizations equal to 10 years. Why is that important or relevant? Well, our last recession that resulted in big market losses was in 2008, 2009. If you add 10 years to 2008 or 2009, that was 2018, 2019. So most, if not all, of the investment losses have been repaid before the 2020 actuarial valuation. So any increases will just offset the large declines due to full repayment of the 2008, 2009 losses. Now, some plans have longer amortizations, more than 10 years, say 20 or 30 years, because in Florida, we can amortize gains and losses for periods up to 30 years. Okay, if we're using a larger amortization period, will not be able to have paid off our 2008, 2009 losses, but because we're amortizing everything over such a long period, the needle won't move much when incorporating the 2020 losses associated with the pandemic. The next line of defense that we have, or at least we hope to have, is federal stimulus. When you look at the news or watch the news, you'll see that there have been several bills that have been proposed that would provide municipalities with stimulus to help supplement the losses incurred during the pandemic associated with lost tax revenues. If that comes to be and your municipality receives a stimulus, it may be a good time to petition your city to put some of those extra monies into the pension, because that may be the city's best access to equity markets to lower their future contributions. Finally, trustee finance education. This is the time to educate our stakeholders, to help them understand all of the safeguards that you have put in place in your pension plan to help ease the burden associated with declining tax revenues and poor economic results in the markets. Remind the stakeholders that while unemployment is at an all-time high since the Great Depression, your city's pensioners continue to receive pension checks that will be spent to help support your local economy. The FPPTA is committed to helping, whether it be with local town hall meetings or any other educational efforts that you can think of to help support your public plan's cause. The last thing I wanted to go into is a case study that we've put together looking at our 200 plus plans that we work for in the state of Florida. If we were to suggest that the 2020 market value return was going to be negative 7%, and of course, we don't know what it'll be until 9/30/2020. For most of our plans, that would generate a smooth return over 4 or 5 years of about 4 to 6%, which is lower than our 7.5% assumed rate. Obviously, those create actuarial losses. If we used a 10-year amortization period, we would expect that the average cost increase would be about 1.4 to 1.8% of payroll. If your amortization period is 30 years, the impact would be less, maybe in the 0.8 to 1% of payroll. Obviously, though, that cost increases for a much longer period of time. So as you can see, with the safeguards we've put in, the cost increase associated with the pandemic would be relatively minor, and hopefully it will not generate another round of pension reform that we saw as a result of the last financial crisis. With that, I'll send it back to you, Peter.
Well, thank you, Brad and Mike. I think the presentations went well. Now we have the fun time with the Q&A sessions. I think, Michael, for your first question, you mentioned rebalancing. That is one of the hardest decisions trustees have to make. Why do you feel that way? But before that, we did have a question, is that could you simply, explain rebalancing one more time? Because I think it was a great question that people wanted to get their arms around it.
Absolutely.
So it's a two-part question.
Yep. So I'll answer the second part of that question first. So what is rebalancing? And so what rebalancing is, in the investment policy statement, there's normally a strategic asset allocation where you have certain dollars allocated to U.S. stocks, international, fixed income, real estate. There's a certain strategic allocation, 50%, 10%, 30%, 10%. And so what a rebalance is that you then put a range around those strategic targets of maybe 10% in large cap with the bigger number. And as those numbers get smaller, maybe 10%, there's a range of 2.5% on the one side and 2.5% on the other. And a rebalance is basically as the markets move and your asset classes fluctuate with market movements, you're just basically taking dollars and you're rebalancing or moving money back into those strategic weightings. So the idea with rebalancing is you're selling when investments are maybe high, and you're investing when maybe investments are low. And so why this is always such a hard conversation to have with trustees, why I just said that regarding we understand the sensitivities and the emotion involved, is normally that if you're talking about stocks and you breach maybe the lower end of that range that I mentioned. So if stocks are at 50%, and all of a sudden, because markets sell off, now your weighting in your portfolio is maybe below 40%. And a consultant comes out and says, we're below our range in our investment policy statement, and our recommendation is to rebalance back to that 50%, or maybe going to the low end of the range of 40 or 45. But essentially, you're saying, are you ready to make a decision to invest probably in an environment based on the news and what you read every day where everything is kind of going against you? The markets are kind of selling, we're in a bear market, and it's very, very hard psychologically to do that. But again, in investing, that's many times, that's why I showed that chart, that's when investors actually make money long-term, is when you're doing things a little bit different. You're buying when the market presents those opportunities, you're investing at lower prices, and then when the markets rebound, like I mentioned they do in every situation, then you're able to capitalize on that. So it's very, very difficult because, again, normally you're doing it in an environment where everybody else is talking about getting out of that asset class. And so you're going against the herd, and that's very difficult to do.
Okay, thanks, Mike. Brad, shifting over to the actuarial side, you had made a comment that you talked about why Florida public pension plans will survive this market downturn. Does any of that part of that statement concern you?
Well, as I mentioned, I feel very confident that Florida public plans are probably better positioned to handle the market downturn than other public plans across the country, and certainly having a meltdown, internet problem here or not, but my screen just froze. Anyway, but what I am concerned about on the Florida space is things like we have drop plans here in Florida, for example, and you may have people that that take the variable interest rate when it comes to their drop, and they see that the market goes down 20%, 15% in a month, and because of maybe the way that their plan is written, they're able to withdraw their drop money and not suffer the consequences of a loss in their drop. So I worry a little bit about how some of our plans are structured from a drop perspective, but by and large, I am very comfortable and confident that our plans in Florida are set up fairly well to handle a market downturn like this.
Well, thanks, Brad. As we know, and I think we'll talk about some of these things throughout our Q&A session, and it's very important because we know that we're coming up to tough times. And I think that you mentioned the fact that, this year is not going to be the toughest time on the investment side, but as 2021, 2022 unravel, we're going to have concerns, and we're going to need to understand all of this, and we will be doing that throughout our educational programs. Mike, question with the market rallying so much since late March, do these tools that you introduced to us change at all?
Oh, that's a good question. So no, I mean, these are, as I mentioned in the presentation, these are time-tested tools that many of them should be in the policy statement and being addressed and discussed at many meetings and frequently. I'll tell you what changes as the market rebounds was really that fifth tool. I think, as I mentioned, the first four were more defensive in nature. You're kind of triaging kind of what's happening in the market and then how that's impacting your portfolio, reaffirming objectives and liquidity, rebalancing, talking to the managers and looking at your manager structure. Those happen all the time. But I think when the market recovers, as of the end of May, the market's up 37%. So we're down about 9.5% from our peak. So still significant, but we've rebounded a lot. I think what's changed on those tools is really assessing, what market opportunities are out there. There's still market opportunities out there, but I think some of those the windows have closed a little bit. And so maybe that offensive nature or the ability to be offensive because the markets are so depressed, some markets may be frozen, or the Fed may be coming out with some program. I think some of that goes down a little bit because the markets have gone up. And so that may be the one tool that may not be discussed as much as it was, the previous 2 months when a lot of clients and we were thinking, how can we take advantage potentially of the sell-off in the market?
Brad, with that in mind, do you think from an actuarial standpoint, how do you engage the market, and how, what are your influences that you watch out for that can kind of raise red flags or get us very cautious of what's going on?
Well, like I mentioned before, as actuaries, we have a very regimented process for how we develop funding requirements. Again, what I get concerned about is the way certain plans are structured, that I'm trying to prevent adverse selection from happening to our plans and to our clients. We don't want people having a run on the bank, so to speak, like they've had in other states. We don't want to have an issue where people are able to take advantage of a market downturn and end up effectively harming the plan. And so while what we do on a daily basis in developing funding requirements is really set forth by our funding policies, what we really have to pay attention to is the plan design, or the design of the plan, and make sure that it's equipped to handle anything like this that may happen.
And Peter, if I can add one thing to that, if you don't mind, I think it's a good point. And I think that one of the things, and I'm really excited to be on this call today with Brad, because I think that another reality that trustees should be thinking about is, you've engaged professionals to help you oversee and administer the retirement system. And I think what Brad was saying there, as far as, we want to prevent trustees or sponsors from doing things that could potentially harm the system. And I think it's important for the investment consultant. I think it's important for us to work very closely with the actuary so that we can say, hey, the reason why we're recommending rebalancing, or the reason why we want to keep equity exposure high, or maybe go higher, is because the demographics of this plan, because what we know markets will do over time, that it may be contrary to what everybody's thinking right now, but this is going to help the plan over time. And these public pensions, again, are the longest of long-term investments. And when you're able to communicate that clearly with the actuary and they understand your logic of why you're doing that, then collectively that can be communicated to the cities and the municipalities so that they understand that, we are trying to protect the system. We're trying not to think 1 month or 3 months or 6 months, but we're thinking that way because we know that there's valuations and there's impact, but we're also thinking how to best over the long term protect these benefits and do what's right for the system.
Well, those are good points,
Well said,
guys.
Michael.
And, it's one of those things that we're in it for a long run. And I think that if any of us who have been around for a long time, we've seen since 2000, as Mike showed, we had 3 different types of market impacts. I remember, and people to this day, and they probably think I'm crazy, but back in the late 1990s, we had trustees thinking we ought to go to defined benefit contribution plans because they could get a better return than the investment managers out of the market. We all have seen it, and it's like making sausage, baby, and it's one of the things. We're in it together. We go through the peaks and troughs. So just thought that, these are very, very good questions. I think one relative, which is kind of interesting, never thought about this, but I had one of our attendees ask, is COVID-19 going to impact the mortality tables?
Oh, wow.
Well, the answer is yes. Is it going to dramatically change it? No. So where I think it'll have an impact is that every year for a lot of our plans, there is a projection scale where we look and see how well mortality improved relative to the way we anticipated that it's going to improve. Most of our plans now, we have to follow the Florida Retirement System's mortality table, right? And part of their mortality table process is that they project mortality improvements over time. And every year they tend to look and see from a projection standpoint how well mortality actually did improve relative to expected. And so my understanding or estimate would be that next year when the MP 2020, they call it the MP whatever 2020 projection scale is revealed, it will say, oh gosh, no, mortality did not improve. In fact, it probably got worse over the last 12 months. And so it would have a positive impact on funding requirements. But I wouldn't get too excited because it's not going to move the needle a great deal. But yeah, I think the answer is that it will. And clearly, time will tell exactly to what extent. If a vaccine comes out soon, it'll be a much smaller deal. If we go 2, 3, 4 years without a vaccine and COVID-19 stays up there with cancer and heart disease and some of the other forms of death that are very prevalent, I think that you'll see a significant downturn in mortality or increase in deaths, downturn in costs.
No, as we all know, and I think when we talked about putting this together and the 3 of us chatted, it's and being in the industry so long, it's amazing how many conditions that we've seen and things that are important 10 years ago aren't important today and vice versa. And, it's a very it's a very, flexible industry. And now that we get more attention, it's very, very important for all of us to understand everyone's position. And I think that's important. Michael, to get to your question here, at the beginning of your presentation, you talked about market perspectives and you compared recent market drawdowns. Are there any other perspectives that you think the trustees should remember so that they can help, that would help them with investment volatility or understanding investment volatility?
Interesting perspectives. Yeah, I think that, one of the things that we always counsel, and the reason why I showed those two slides, and I said this during the presentation, is that it's so easy to get wrapped up. You go home and you start watching the news and you just get wrapped up in the moment. You get wrapped up in the world's coming to an end and everything that we were thinking before, doesn't make sense. And it's very in the moment. And the reason why I was talking about those perspectives was because it's so important when you're a trustee on these plans is you got to kind of know what's going on in the moment, but you have to think strategic and you got to think big picture. And so those perspectives were just some big picture reminders of the market. And I think that another one that we have really been talking about internally, and I know we're talking to some clients about, and I don't think it's that big of a surprise, but it's always when you hear the numbers, I think it's interesting. But going back to 1926, okay, so we're talking just after the Spanish flu, but you're talking world wars, you're talking crises, you're talking, things with our country, I think that we're dealing with today, which hurts. But how has the market responded through those? And I think what's interesting is that the S&P 500, again, going back to 1926, if you look at it on rolling time periods, and if you look at it 1 year, 3 year, 5 year, 10 year, and 20 years. So going back to 1926 on those rolling time periods, that 75% of the time on a 1 year period, the S&P 500 is positive, right? 75% of the time. That was a little shocking because you think, boy, I know the last few years we've been, the post the financial crisis, been a bull market, but going back to 1926, 75%. And over that 1 year time period, the average return for the S&P 500 is 12.26%. Okay, 12.26% over that time period 1 year. You go out 3 years, the S&P 500 is positive 84% of the time. Okay, I think that's pretty interesting. So only 16% of the time is the S&P negative on a rolling 3 year period, and the average result over that time period is 10.7%. Okay, so still double digit. You go out for the 5 year and the 10 year, and it's the S&P is positive 88% of the time, 5 year, up 10.14%. It's up 10.4% 15 year, and it's 95% it's positive. Only 5% on a 10 year is the S&P negative. And here's what's interesting. On 20-year rolling time periods, going back to 1926, which is really when you have good data to do this, the S&P has never been negative over a rolling 20-year time period. Never been negative. And it's up almost 11% over that time period. And so Brad talked earlier in his presentation about the actuarial realities and why he feels relatively good. No question there's things we have to think about, but he was talking about smoothing and he was talking about the amortization and the time periods he was talking about. And I think just the perspective of knowing what the markets do over long time periods and using that as your biggest asset is something that's very, very important and something that I think all trustees should remember. Because again, 1926 to March 31st of 2020, that's a really good data set there. And that's just what I explained to you kind of. So I think we should feel relatively confident that we may have similar results on a go forward basis. And I think that's just an interesting perspective to remember, during this environment.
Well, it shows true, Michael, and thank you for that. I have had a couple of questions from the audience, and they were asked about Brad, and I know this must be from one of his fans. The first one is that, are you wearing pants, Brad? I'm only being paid for doing the job, I guess, Brad. So I want to make sure that we keep your followers up to speed. Now, this next one I think is a great question. The COVID mortality tables, as we discussed earlier. The question is, it is possible that we could see an acceleration in retirements. And what would the impact be on increased benefit payments in the near term? Brad, I think you're muted. Brad, I think you're muted.
Let me try again. There we go. That was my bad. You didn't even get to hear my joke then. Did you want me to stand up and see my pants, or is that what I'm hearing? No. Anyway, so the question about benefit payments. The an increase in benefit payments could have liquidity concerns, which Mike can address. An increase in retirements might enhance the upward mobility of the membership, which could actually increase salary increases amongst the active workforce. There won't be as much drop usage, for example. People may just say, hey, I need to get out. I don't want to be part of this anymore, especially on the public safety front. I've talked to a lot of my public safety clients, and they've told me how their lives have changed dramatically as a result of COVID-19. Firefighters aren't just going into people's homes like they used to. Police officers aren't just leaning in to a car door when they're pulling somebody over like they may have once done. And so you're right, there may be an increase in retirements. If people start retiring earlier, that tends to increase pension costs, believe that or not. We're paying them for longer, okay? Usually, at least in the state of Florida, if you retire early, your benefit is only reduced by up to 3% per year. So you're not getting a huge haircut for retiring earlier, okay? And so that increased time of retirement with a small haircut tends to increase pension costs, okay? When you combine that with increased liquidity concerns, I think that an increase in retirements could actually be a headwind for pension costs. It actually might increase pension costs across the state or across the country.
Okay, what I'd like to do in fielding these questions also is the fact that I know we're coming up to 3 o'clock. We don't have a hard stop at 3 o'clock, okay? I'd like to continue, and I would probably think that we might continue to 3:15, no later, but if that's okay with Mike and Brad, just so that I've got probably 4 or 5 more questions that I have that have come in through the audience that I would like to ask. So if that's okay, those of you that have to go elsewhere, thank you very much for being with us, and stay tuned. Our next session will be June 17th, and we'll talk more about that, and you can see it on the website. So having said that, Brad, we've got another question for you, is that what type of drop structures might be detrimental to the fund?
Well, I've got some drop plans that will guarantee a fixed return of, say, 8%. When you have a guaranteed fixed return of 8% and your fund loses 9 or 10%, the fund has really lost on that deal. I think that a more plan-friendly drop structure would be one where the drop return is tied to the actual fund return, and maybe less, a percent or two, so that if the plan loses 10, well, that person lost 12. Hate to say it, that's no good, but from a plan's perspective, when you are having a high percentage of your members in drop. And some of my plans allow members to keep their money in drop after retirement, and they still get a guaranteed rate. That adds a whole lot of risk. And those are the kinds of plans that I worry about when we have a downturn in investments. And so those are the types of structures that give me a little bit of a heartburn as an actuary.
Yeah, we all can get heartburn every now and then, depending upon what's happening. But it's so very important to be looking at this. And there's a great questions that we're assessing each and every one of our plans. Mike, I'm going to give this one to you to start off with. I'm quite sure that Brad might have a comment as well. It is obviously hard to predict, but with elections and possibly more cases of COVID-19 ramping up, how will the economy look in the future? Now, we're not going to hold you to anything, obviously, but you can give a perspective. And I think that everyone watching, don't write this down because nobody can predict. But why don't you give a shot at that? I think you'll.
So what do we think? Can you repeat that, Pete? Is it, what do we think the market, kind of economics and market over the next 6 months, kind of through the election cycle, or what specifically? Is that it?
I would say that the question is intended to being that we're going to have changes by the end of the year, whether, an election's coming, and we also have maybe the second phase of COVID-19. And I believe the gentleman, whoever's asking this question might be saying, with that in mind, how could that impact going forward to 2021?
Sure. I think that a lot of investors, I'm gonna look at it from the investment side. I think, it's great the markets have rebounded. I think that, a lot of scratching heads saying up 6-7% since the trough, and it's just the economy's been closed a lot of that time. I know we're starting to reopen, which is great. I think you've got very low interest rates. I think the federal government is injecting tremendous amounts of liquidity into the system. And so all those things are positive. I think that what you're seeing in the markets is that the COVID situation may be better than what people think. I know there's no vaccine yet and still some uncertainties, but some of what we were originally hearing, as far as how it's transmitted and different things, maybe that's coming down. And so those have been positive for the markets. But what markets don't like is uncertainty. And I think that obviously with the election coming up in November, I think as more information comes out and we see how the economy rebounds with the reopening, I think data is going to come out that's going to drive the markets. And I think over the near term, it's going to be very, very volatile. And so, as much as I want to see things continue to go up, I think that, a lot of the rebound is kind of baked in on good news. And so it's going to be, it's dicey, I think, for the near term. And we're just going to, again, go back to those tools and kind of keep thinking about long-term objectives. But with all that being said, and I know I'm kind of dodging the question here, because again, I think that, near term, it's going to be choppy. And I think it's going to be very headline driven. And if, again, we get hot spots and things reemerge, I think the markets could sell off again. But you stay the course. I think that, portfolios, the way they're allocated, are going to do very, very well. And they're going to be able to meet the objectives that we're trying to accomplish.
Michael, can I ask you a question?
Absolutely. Sure, I am wearing pants, Brad. I am wearing pants.
Okay. Yeah, no. And I'm not even going to ask you what the projected cost increase would be. It was for a plan with a 30-year amortization period. It's the last line in my slide. I don't know if you recall that, but that's not my question. Yeah, my question is this, and that has to do with active versus passive management as it pertains to COVID-19. Do you believe that because of COVID-19, there are going to be certain industries that might be represented in indexes that really don't have much of a chance to do well over the short term? Like, for example, I don't imagine a lot of people are planning their next cruise right now. And so maybe the cruise stocks are probably not going to do well over the short, medium term. Same could be potentially said about casinos or even the airlines, for example. I'm just wondering whether or not that you believe as an investment professional that this is the time where, one of the unique situations where good active management has a chance to really outperform the passively managed indexes.
That's a great question, Brad. And I'll tell you that I think based on the uncertainties I mentioned as far as the next 6 months and the things that you talked about as far as industries changing and fundamental active portfolio managers being able to kind of modify portfolios to take advantage of that. Yes, the short answer is that this could be a very good environment for active managers to outperform their the more passive indexes. I think, you go back to 2009 until this most recent drawdown, there was a lot of, cash that went into the system, kind of a reinflation of all assets. And that kind of really was a boon for indexes. But if you have a lot of uncertainty, if you have a lot of volatility, that should be an environment where fundamental managers, active managers can have an advantage over the index funds. Right? That's, kind of a general statement, but yes, that's kind of why fundamental active managers, that's why they have a little bit higher fees for environments like this, when they can position the portfolio to maybe take advantage of some of these nuances associated with the new world that we're potentially living in. Yep.
Thanks, Mike.
What I'd like to do too is just kind of revert back is, with the economic question, we had our first session was, we had two economists. We had Liz Young and Samantha Azzarello, who shared their economic outlooks with us. And like I said, they're just outlooks. But here again, you can get that session on replay if you go to the section in our FPPTA website. It's in our virtual library. And as this session will be history in a few minutes, that too will be put into the library. So just wanted to remind those. And I think from my perspective, one of the toughest things that we have to do, and I hope that we have, agreement on this, but we have through our trustee base that we have a wide range of experience. And I think that right now we have to really ask our experienced trustees to help our newer trustees, because we know that we're getting new trustees coming onto boards, and this is going to be their first experience. They weren't here in 2000. They weren't here in 2008. They're rocky times. It's easy when it's good times, but it's a little bit different. And I think the word both of you used so far is that it's got to be patience, and you got to understand what's happening. And I think that we're all in this together, and this is what our objective is, trying to share with everyone in our industry. And I just thank everyone in doing that.
Peter,
Yep.
One thing additional, and I think that's so true. The patience and the expertise and the knowledge transfer of some of the trustees that have been around longer. But the other thing, and I mentioned this earlier, and I think it's very, very important, is that I think that, these retirement systems have paid for professionals to help them administer the retirement system. And so many times we see that, the actuary comes in and they do the actuarial report, and the investment consultant comes in and we stick to our investment consultant report. And what we need to do is we all have the same objective. We all have the same goal, right? And that's to help these retirement systems make good decisions, that keep those contributions level, flat for the city, that protect these benefits for the retirees, for the future retirees. And I think we need to just continue to really work together, understand that, yes, we have an area of expertise as investment consultants, but we can work with the actuary and the attorney and the auditor and others as we try to react and respond to this environment so that we can best serve our mutual clients. And I think that's important, that we have to remind ourselves of that, we being the service professionals, but also the trustees need to really challenge us from the education aspect and to help brainstorm collectively to best serve them.
I agree totally, Mike. And I have seen a tremendous amount of cooperation when I go to meetings and I see folks talking to their, when we first started this, we've got the finance people from the city sitting at the table. We've got the union folks sitting at the table. We've got the service providers sitting at the table, and we're all making decisions together. There's no, there's not anything one-off, and I think we make good decisions. And I'll tell you, Florida is very fortunate. We have a lot of talented folks in our organization through our associates. And, I think, as Brad stated earlier, Florida is in much better shape than most every other state in the United States. And I come from a state, as you know, I talk funny, but from Massachusetts, we weren't in as good a situation. So I'm learning, and being a Florida resident is a treat. So, Brad, I've got a question. I'm going to read this. I think it's from one of your clients, but it's an interesting question, and I think it's a response to a comment that you made. The message is, our plan recently combined all of our unfunded liabilities and lowered them all to below a 15-year amortization schedule. And our latest annual state report showed our plan to be close to 100% funded, assuming that we hit all assumptions by 2033. Does this downturn affect the date? And would we be better sticking with the 15-year amortization schedule going forward, or set this loss on a separate longer schedule to 20 or 30 years, or stick with just the 15? Maybe you might need to backtrack that a little bit for everyone else.
No, so I think the heart of the question, if I understood it, is, do we treat this loss associated with the pandemic differently than we're treating the rest of our unfunded liability for amortization purposes? And I would say the answer is no. What I would suspect is that while this plan is very well funded, it's going to, this loss will probably be trickling in over the next 4 or 5 years, because I'm sure that this plan probably has smoothing, right? So there's going to be losses each of the next 4 or 5 years, let's say, and so it's not really just 1 year that we would be talking about in terms of the impact of the pandemic. It may be, 4 or 5 different losses that occur. With that said, especially since you're 100% funded already or close to, I think a 15-year amortization is perfectly fine. I can also say that if you start treating losses, let's say you have a big loss and you say, I'm going to amortize that over 30 years. And then the next year, we have a big rebound, and so we have a gain, and we're going to amortize that over 15 years. The Division of Retirement won't like that. I've seen plans in the past in the state of Florida get in trouble for amortizing their losses over a longer period of time and their gains over a shorter period of time. And so there's going to be a little bit of blowback that you would get from the state if you tried to do something like that. I do believe that your actuary was giving you good advice, however, in combining whatever unfunded liability you have into one 15-year base. And the reason is just because what's likely occurred is that you've just now paid off your 2008, 2009 losses. Those have probably all been paid off. And so the city was about to get a large contribution drop. And so what we did was we combined everything into one so that their contribution rate didn't fall substantially, only to have it come back up. And so what this did was it created, as Mike was mentioning, more level, stable contributions going forward. And I really, again, do not believe that, unless something else happens in the next few months of this fiscal year, I really don't believe that we're going to see huge increases in pension costs associated with this loss.
Okay, Brad, thank you. I've got 2 more questions, and then that will wrap it up. Mike, I'll try to hit you with this. It could go either way. One of our participants asked, what sources of funds for contributions other than a city's tax revenues can be looked at in addition to federal stimulus, assuming this is available?
What additional funds?
Correct. For contribution's sake, I think that.
Right, and you said not including federal?
No, they're talking about, can be looked at in addition. Okay, so in addition to the federal stimulus, if that happens. So what other funds that, the cities and municipalities can look at, or is there some other contributions that, revenues that can come in to help pay contribution?
Oh, I mean, Brad put the calculation up earlier. I mean, you've got the obviously the employee, you got the employer, you've got investments, right? There's investment contributions based on gains and dividends, income. Obviously, Brad also mentioned some of the things that the federal government is looking at, stimulus packages that governments can use to help with some of these costs. Off the top of my head, I don't know any other sources. I would punt that one over to Brad from a contribution standpoint.
Well, I think maybe they might have been referring to things like extra taxes, for example, and that is certainly a possibility. A portion of sales tax and property taxes, as you know, for police and fire. The state premium tax dollars help subsidize a majority of our police and fire plans in the state. And I have a little bit of concern about those monies going down a bit as a result of the pandemic. With unemployment being high, you may have more, it may impact the housing market, people may not be going out and buying new cars. I've seen the savings rates going up. And so you may not have quite the level of premium tax dollars. But really, I think what we're getting into is more of a tax situation. Does your local municipality have the wherewithal or the ability or interest in increasing taxes to help with funding requirements?
And that's absolutely true. And this is not new, but I think that where interest rates are, and maybe before the market recovered 35%, and this has happened historically, but another way to get funds is obviously to issue bonds. The city can issue bonds, pension obligation bonds, at interest rates, depending on the credit of the city, that may be attractive today based on the Federal Reserve lowering interest rates so much. And then over a long term, 20, 30 years, if the interest rate on that to finance it is 2-3%, and we're structured to get 7%, that's a way to get some sources in and then to pay it back, hopefully, and have a little bit of margin for some additional monies or to make out on that financial transaction. So again, that's nothing new based on what's happening now, but it could be attractive based on valuations of where markets are and where interest rates are.
And I've seen, Mike, that a lot of our clients have started to look at this because it is a unique opportunity, as you mentioned, with extremely low interest rates. Getting passing a bond and tossing that money at the pension, especially when the markets are somewhat low. There's certainly quite a few of my clients that have explored that concept.
Right.
Well, I think I think the key too is that it was a great question because it's also going to set up our next session that we're going to have in a couple of weeks. But before I advertise that, I'd like to just kind of end it with one last question. Start off with Brad, and then Mike, you might have a comment as well. But Brad, the question is, have you had any discussions with the Division of Retirement, the League of Cities, or any of the unions regarding funding relief?
Yes, I have actually, and I've had some of those discussions with Mike and with you, Peter, and other members of the FPPTA. I was actually very encouraged by the fact that getting the League of Cities, for example, to want to be part of a call to discuss funding relief. The Division of Retirement they're as helpful as they can be, but they certainly need some kind of legislation passed for them to be able to really do much. But we did have some discussions. The League of Cities, though, I found one of the things I found interesting is that, at least as it stands today, they don't seem overly concerned about the market drop and how it's going to pertain, how it's going to impact their cities, for the reasons that I mentioned on this call. They know that the market drop will be rearing its ugly head starting in fiscal 22, and so they're not so concerned about 22 right now. They're a little more concerned about 20 and 21, but that has nothing to do with our pensions, really. And so they said that they would be willing, to continue the conversation as we move along, and I think the unions would as well. So I really feel like, more so than in the past, some of the other stakeholders that tended to feel like our adversaries really want to come to the table and work towards a common solution here. And there's less talk about trying to eliminate our pension funds, but rather let's work with and administer these funds properly and make it so that our members are taken care of, and those that sponsor those pensions can have level, stable, and predictable contributions. So I'm really encouraged. Yes, we've talked about it. Nothing is really on the precipice of happening. I know there is one attorney in the state that has drafted up a potential executive order for DeSantis. I don't know where that's going. A lot of us gave comments on it. But I think that from the city's perspective, sponsors' perspective, they're not as concerned as I expected them to be.
And I would just
comments on that?
No, I would just echo. I mean, and again, FPPTA has done a great job of kind of spearheading this and helping facilitate and kind of coalescing all the different groups that Brad mentioned. And I've been very encouraged based on just trying to think through and do what's best for all parties. It's been very encouraging. And so, as Brad said, nothing really final yet, but the communication channels are open, and that's what's the most important thing. So I'm sure as we go forward and the markets do what the markets do and we get more clarity, we'll have lots more conversations to do what we can to protect all the people that Brad mentioned.
Well, thanks, guys. I'd like to thank you personally, both Mike and Brad, for providing the FPPTA with some great insights. This is one of many that we're going to be handling, and there's topics that, as we even mentioned today, you get ideas of saying that we're going to have future sessions, whether they're live at our event that we hopefully will have in October, or if they're going to be through virtual sessions like this one. I think that we have a wide array of new educational formats, and I know that we want to keep the trustees up to date and up to speed with what's happening across the state. I'd like to raise a special thank you to our generous associate members who have supported this new educational initiative, which is the FPPTA Virtual Learning Series. We could never do it without you, and we really appreciate your help.